The S&P 500 on track to snap a 6-day long winning streak as fears creep in that recent investor confidence has been overblown. Forget buying the dip, though. Our next guest says it's time to de-risk and instead focus on quality dividend-paying stocks. Joining us to discuss whether this is the moment for dividends, we've got Max Wasserman, Miramar Capital co-founder and senior portfolio manager, and still with us for the conversation, Chris Versace. Max, it's great to have you on. I've been trying to talk dividends for about 6 weeks, so I really appreciate you being here. Talk to me about why dividends make sense for investors right now.
Sure. Well, I'll say they make sense all the time, but if you go back to the 1920s, they say about 40% of the total return of the S&P 500 has been dividends. And in certain 10-year decade cycles, it's more and sometimes it's less. But the bottom line is you're getting paid to wait. Nobody can time this market up and down, and the cash flow is coming in every quarter from the dividends, and you get to reinvest it. So you can either take the money out or you can reinvest it the way you want to. And for people who live off income, a treasury bond's giving, let's say, 4%, 3.5%. We look at a dividend growth portfolio, so we have about a 3% yield. So we're getting over 80%, which you can get in a treasury, plus growth. Yeah. So for people who need cash flow, dividends are an excellent way. Also in terms of volatility, the market. If you go the first half of the year, the market's all over the place. Dividend stocks hold up better in times of craziness, volatility. So we like it. And we think the investors are overlooking the basics of investing. They just want the hyper growth, but it can go away in a moment. But dividends are steady. And for somebody who wants to be a long-term investor, we think dividends are the best place for it.
Was that shade towards the big tech stocks that I
we own some big tech stocks. We like them, but the valuations are out of control, right? At 30, 40, 50 times earnings and some. And the market's overcrowded. Everybody buys the same 7. You're looking at those stocks. We have some of them, and they do pay dividends. Some of them pay dividends, and they're paying more as time goes on. But for valuation level, we just don't think it's worth the risk to keep buying them, right? Buy them judiciously, we like. But the rest of the market, right? The rest of the market looks relatively inexpensive compared to the NASDAQ. And we think if you can get 3%, 4% yields in growing areas, that's a great place for the investor to be.
So what are some of those areas that you think are most entertaining, let's say now, for investors?
Sure. Nobody likes pharmaceuticals right now. Nobody. You can't give pharmaceutical stocks away. But companies like AbbVie that we have an investment in, it's paying you 3.5%, and they're growing the dividend 8% a year. Financials selectively, we own a company called CME, right? Chicago Exchange. They pay about 4%. They give you a dividend of roughly about 2%, but they give you a fifth dividend at the end of the year, right? Especially pay out all the profits usually to the people. Those are good things. Industrial stocks are good. Energy, which nobody likes energy right now. They did about a quarter ago, and they're paying you 4, 5, 6%. So you do a mixture, and you even throw retail stocks in there, like the Home Depots of the world, which I know came out today, we like, and you look at those. If you put them together, you have a good dividend portfolio with growth. And that's the key. We're not buying utilities. We really don't own a utility in our portfolio. But we look at other areas of the market that are growing the dividends, paying higher cash flow.
So let me ask you this. So you're talking about yields, 3%, 6%. At what point do you use the dividend yield as a signal that something might be wrong? Is it 8%, 9%?
Oh, that's a great question. When we look at the dividend yield, we're looking at the payout ratio. Look at how much of the earnings are being paid out to cover that. And when a company is paying more than their earnings per share, that's a cause. Or if they're telling us to slow down in the dividend growth rate. So if you're starting to see a massive slowdown from a 10, 8, 5, 3, 2, there's something wrong with the cash flow. But it's a great valuation tool, right? The relative dividend yield to itself, right? What's its own payout ratio to the market, to the treasury? We look at that compared to the treasury. So we look at it all, but it's an excellent valuation tool. But the payout ratio to us is one of the key things. You have to watch how much earnings are coming in to how much you can pay out. And when a company starts getting 70, 80%, it requires a lot of attention.
Can we apply that payout ratio thinking then to some of those Mag 7 names as a framework for which ones are the best dividend payers? You've got 5 of the 7 paying dividends. How do you use that framework to decide which ones are the best?
Well, the payout ratios, I don't look so much because they're usually 10, 20, even 30%. That gives me opportunity for expansion, though, in dividend payout. So that tells me when a company's doing 10, 20%, you can pay out more as time goes on. We look at cash flow growth, right? And return on equity, what are they doing? But the big 7 tech, it's all about their capital expenditures right now, right? Where are they going to pay out? Where are they going to reward? And they're doing buybacks. That to me is like oversimplification. All you do is just keep announcing you're going to buy more of your stock back, but in reality they don't. They're just increasing how many they're going to buy. But if you look at the buyback announcements, they say I'm going to go from 5 to 10, but they're still at 5, right? So you have to look at what they're actually doing. So we look at the outstanding, shares going down,
Right.
and a lot of them are just paying back their, options they gave to their holders, right? So we look at it that way. But there's a lot of value that can be made there. But 50, 40, 30 times earnings, we're saying you're not buying those for dividends. You're buying them for dividend growth. And it's a little bit different.
No, I see what you're saying. I am curious too. I spoke with the CEO of Public yesterday, which is an investing platform, and he talked about how retail investors are obsessed with dividend-paying stocks, and that there are all of these financial communities online that are talking about the importance of dividend paying. Have you seen that activity and interest from retail in dividend-paying stocks?
It's interesting. Our clientele, we sort of have to convince them of the value of dividends, because everybody on TV is everybody talking about growth, hyper growth, right? The Bitcoins, you buy that. So we try to educate our clients the value of dividends. Yes, it's good, but don't chase yield. There's a lot of great Dow stocks there used to be that cut their dividends, right? Are no longer paying them. Great companies such as Boeing, Disney, they had to cut those dividends. So you have to watch what you're investing in. Do they have growth in earnings? Do they have growth in cash flow? Cash flow, we spend a lot of time with fundamentals, right?
Yeah.
So we're looking at that. So for the investor, I would say, yes, dividends are a very big component, but get a mixture in a portfolio. You want dividend growth, you want a little bit higher yield, but if you're getting something 7, 8%, there's a reason. It's usually the prices come down or they're getting ready to do something. Don't chase high yield. Even 2% and 1.5% dividend yield companies with growth is tremendous.
And maybe think of it like I want to be invested in this company regardless of what they do with the dividend?
Well, no. For us,
No?
it's no. We're
Like
very
a Disney,
strict.
for example,
Disney,
right?
for us,
Do you still
if
like it if they don't pay a dividend?
If you cut the dividend, to us, that's it. We're not happy. Because if you have expectations and you're telling us the dividend's going to grow, and then a problem happens, you're not managing capital allocation correctly. Right. You're misallocators of capital. And for us, that's a sin, if you will. It's really bad. We entrust the shareholders, the management, to treat our capital with respect, because we look at it, our firm looks at it as we own a part of a company.
Right.
Yeah.
And if you can't treat our capital well, if we can't trust you with capital allocation, we're gone. So
Very
dividend
punitive.
to us,
I understand.
we're gone.
Max, I've got 30 seconds left or I'm going to get in trouble. But if retail investors have been buying just NVIDIA, just the S&P 500 index, how do they get started in dividend investing?
Well, it depends on the side. There's a lot of good ETFs out there that pay dividends. We like them, dividend growth. You get a mixture. I would look for companies I understand and investments that pay a dividend. And in every sector, there's a good paying dividend stock. You just have to look. So if you like big tech, look for those who have a dividend policy that you like. We have investments in the Microsofts. We have investments in Alphabet now. We have the Broadcom. Actually, Broadcom, which we own investment, has been a tremendous dividend payer. People just don't realize that. So we say look in those areas that excite you, but look for dividend paying stocks.
Max, really appreciate it.
Thank you
so
so
much for
much.
coming in. We'll have
Appreciate
to
it.
have you
Thank you.
come back soon.